Welcome back to Market on Close. I'm Caroline Woods. It's time to focus on investing strategies for your portfolio. Let's welcome in Nigam Arora, founder of the Arora Report. Nigam, great to have you back. Thanks so much for joining us.
Thank you for having me, Caroline.
So I saw your post on X teasing our interview, saying that we're going to talk about how to consistently beat the market. So tell us, what's the strategy? How do we do it?
Well, Caroline, very simple. You have to think ahead. What most investors do, they suffer from a recency bias, meaning they look at primarily last 10 days, maybe, and that's what influences them. But you got to look ahead a month or two or three. And I'll illustrate it. Back in February of 2025, when market was hitting new high, everybody was bullish. We were looking ahead and saying, well, these tariffs are going to come, market could go down. So, and with very large profits. So we were taking profits, raising cash, and we divide in two buckets, so to speak, our positions. Strategic positions, very, very long term. We were holding Apple long from $4.68, Nvidia from $12.55. And then we had a second bucket of shorter term positions. So longer term positions, we were hedging them. And so what happened is we were 80% plus protected. So when the market went down, those hedges became very, very profitable. So we took profits on those hedges, and now we had a lot of cash, and we've been buying. Now when everybody's bullish, we're still bullish, and I'll explain in a second why we're still bullish. But now we're looking ahead, and we're saying peak tariff or trade uncertainty is behind us, but peak economic uncertainty is not. Okay, that doesn't mean market is going to crash again, but we're still looking at about 60% probability of stagflation. We lowered that. We were at 70% after yesterday's China deal. We don't think we're going to see a recession, but we still see about 35% probability. So going forward now, we are in what we call adaptive mode, meaning our algos look at the data every day and decide. So right now we're buying, but as market moves higher from here, we're going to start taking profits on our tactical positions. And if market goes even higher, then we'll start hedging our strategic positions. So we're looking ahead. So the key to consistently beat the market is not get so much influenced by what happened over the last few days, but look ahead. What's going to happen a month or two from now? Now, the one reason we are bullish in a very short term is because we analyze a lot of data and we dissect in several ways. And what we see is that institutions were fully invested before the dip. And when the market dropped, some of them sold, but they did not buy. And they started buying only yesterday, and they're buying today. That's why, even after yesterday's rally, we continue big rally today because institutions are now underinvested. They're still buying. So what's going to happen is institutions are now in the chase mode. And if there's any dip, that's going to get bought. And that's what we're going to do. Any dip we're going to buy, at least for the time being. But we're going to have an eye on taking profits on our tactical position and start hedging our longer term positions as the market goes higher.
Okay, so kind of a two-part question here, and let's start with the dip buying, because then I want to also talk about how you're preparing your portfolio for a greater than even percent chance that there's a stagflationary problem. But in the shorter term, what dips do you want to buy? What's on your list, if you will?
Well, for example, we bought UnitedHealth today. Now, we have not owned UnitedHealth in couple of years, right? It ran up to 600 something. Now it's 318, 320, wherever it was. Around 318 we were buying. And the reason, and again, previous dips in United, I would get a lot of questions. Should we buy UnitedHealth? Should we buy UnitedHealth? It's down so much. The answer was no, because we use a lot of quantitative analysis. So today is the first time when we are seeing signs of capitulation. Not full capitulation yet, but we're seeing signs of capitulation. People are just throwing in the towel and say, we can't handle this, right? And we have plenty of cash, and we don't own it, so we are buying it today. recently, on the lows when Bitcoin was hitting, 78,000 and so on, we were buying Bitcoin. We're kind of holding that. We're buying Microsoft near the lows. Earnings came out good, so we were there. There's a stock I'll mention. It's a utility company. Symbol is T as in Texas, X-ray, Nancy Mary. This is a New Mexico utility, which we are buying now. It's not going to run up like a rocket ship. It's a utility, they just serve electricity. But we think the company is going to get bought out. So it's a special situation. And we had a lot of our portfolio companies bought out, 205 so far. So we think this is going to get bought out. So those are the kind of things we look for. Now, your second part question, so we're talking about better than even chance of stagflation. So what do we buy? So one of the stock we have is Boston Scientific, symbol is BSX. And Boston Scientific makes stents, pacemakers, defibrillators. And the point is, stagflation, inflation, deflation. If somebody got a chest pain, they go there and they say, gee, you need a stent. Well, you're going to get a stent, right? You're not going to say stagflation or I'm going to lose my job or inflation is high. So, and the earnings are great. We own from low 20s. It's moved up a lot, but along the way, we keep on buying more. So that's an example of stagflation. The other is the cybersecurity. No matter what happens to the markets, no matter what happens to inflation, nobody's going to cut their budget for cybersecurity, right? With AI, we got more bad actors because bad actors are now using AI, right? So we need to strengthen our cybersecurity. Now, the problem, so it's a kind of a stagflation proof. But the problem with cybersecurity is there are a lot of stocks, and sometimes one is dominant, sometimes the other is dominant. So for short-term trades, you can pick individual stocks. But for strategic long-term investment, it's better to pick a ETF. And we are in an ETF called HACK, H-A-C-K. So those are the kind of examples, we're preparing our portfolio. We're planning to pick up here some Unilever, which is like a Procter & Gamble of Europe. We think Europe will still continue to do well. Again, people are still going to buy soap and shampoo and all those things. So as we go on, we're adding more and more positions that will do well in stagflation. And then what we'll do is our cyclical positions, we'll start hedging them as market goes higher.
Okay. Nigam Arora, founder of the Arora Report. Thank you so much for all of those picks and your insights. Really appreciate it.